4 times a year, every listed company has to replace expectations with evidence. A quarterly report reveals what the business actually sold, earned, spent, and expects next. The market reacts immediately, but that first reaction is often based on incomplete interpretation. That is what makes quarterly reports so tradable. The opportunity is not simply that stocks move. It is that new information arrives faster than investors can fully understand it. Between reports, the market relies on estimates, industry data, previous guidance, and assumptions about demand. When the release arrives, those assumptions are tested at once. Revenue becomes known. Margins become known. Cash flow becomes known. Guidance may change. Management then has to explain why the quarter looked the way it did. The report creates a clear line between what investors believed before the release and what the company has now confirmed. Price instability appears when those two versions of reality are far apart. A common mistake is to reduce the event to whether the company beat or missed consensus. Markets do not react to whether a number looks good in isolation. They react to whether it was better or worse than what was already priced in. A company can report record profit and still fall because expectations were even higher. Another can report weaker earnings and rally because investors expected a much worse result. The quality of the result also matters. A profit beat caused by stronger demand is different from one caused by lower tax or delayed spending. Strong cash flow can reflect operational improvement, but it can also come from inventory timing. Revenue growth can look impressive while margins reveal aggressive discounting. The headline tells you the result. The underlying drivers tell you whether it matters. Every report is judged against several forms of expectation. There is formal analyst consensus, company guidance, investor positioning, and the narrative implied by the recent share price movement. A stock that has risen sharply before the report may need an exceptional quarter just to hold its valuation. A heavily sold stock may only need evidence that conditions have stopped deteriorating. This is why similar results can produce completely different reactions. The starting expectation changes the meaning of the release. A quarterly report is also not one isolated moment. The document appears first. Automated systems scan the headline figures. Analysts compare the release with their models. Management publishes a presentation and begins the webcast. Prepared remarks add context. The question and answer session exposes the areas where investors remain uncertain. The market keeps updating throughout this process. Sometimes the decisive signal is visible in the first table. In other cases, it appears later when management explains a margin change or avoids answering a direct question. Important information often hides in wording rather than numbers. A company may change its description of demand from strong to stable. It may stop mentioning a backlog that previously received attention. Management may describe weakness as temporary while inventories continue rising. A small change in language can alter the meaning of the entire quarter. The useful comparison is not only between current and previous numbers. It is also between what management says now and what it was willing to say 3 months earlier. Confident executives usually speak with precision about timing, pricing, volume, and geography. Uncertain executives often become vague and rely on language, such as maintaining flexibility or monitoring conditions. Those phrases are not automatically negative. Their importance comes from the change in tone and specificity. The question and answer session is particularly valuable because management has less control over the direction of the conversation. Analysts ask about issues the published material did not resolve. They challenge assumptions, press for timing, and try to separate one-off effects from structural changes. Repeated questions reveal where confidence is weakest. An evasive answer can matter more than a polished response because it shows which part of the story remains difficult to defend. The first share price movement should also be treated as information rather than truth. Early trading can be driven by headline numbers, automated orders, stop losses, thin liquidity, and investors closing positions held into the event. A stock may initially fall on weak margins and recover once management explains that the cost was temporary. It may rise on strong revenue and reverse after guidance is reduced. The first move shows what the market noticed. The later move shows how the interpretation developed. To judge whether the reaction is reasonable, compare it with the full event. Consider the size and quality of the surprise, the change in guidance, valuation, investor positioning, sector performance, and the broader market. A large fall after a minor disappointment may reflect an expectation reset, forced selling, or poor liquidity. A limited reaction to serious deterioration may suggest that the market has not fully processed the change. Price is evidence, but it is not the conclusion. The most useful report trading process begins before the release. Start by defining the market's current view of the company. Identify the few variables capable of changing that view. For an industrial business, orders and pricing may matter more than reported revenue. For a bank, credit losses and net interest income may dominate. A software company may be judged on recurring revenue and retention. A retailer can grow sales while promotions weaken profitability. The important metrics depend on the economics of the business. A good preparation process reduces the report to a small number of questions. The release then shows which assumptions survived and which failed. After publication, the analysis can be organized into 4 parts: expectation, result, explanation, and reaction. Expectation defines the benchmark. Result measures what changed. Explanation determines whether that change is temporary, structural, or misleading. Reaction reveals how the market repriced it. The tradable setup appears when the market reaction does not align with the complete interpretation. That does not mean every mismatch should be traded. It means disagreement has become visible and can be evaluated. Historical context helps separate a genuine turning point from ordinary quarterly noise. A single margin decline may not matter if it reflects planned investment. The same decline becomes more important if it has continued for several quarters, while management repeatedly described it as temporary. History also shows whether guidance has become less specific, whether inventories are normalizing, and whether similar releases produced temporary overreactions in the past. Patterns do not guarantee outcomes, but they provide a better reference than interpreting the quarter in isolation. This process can be especially valuable in smaller markets. Large companies receive immediate coverage from analysts, funds, journalists, and automated systems. Smaller markets often have fewer estimates, less research, and more fragmented information. Reports may be published in local languages. Webcasts can sit on separate platforms. Important details may be buried in presentations that receive limited international attention. That does not make the market easy. It makes the quality and speed of analysis less uniform. An investor who can organize the report, transcript, expectations, history, and price reaction may understand the event before a stable market view has formed. The advantage is not access to secret information. It is the ability to structure public information quickly. The surprising part is how manual this workflow still is. Investor relations pages must be checked. Reports have to be downloaded. Previous quarters are opened separately. Webcasts are located, transcripts searched, estimates compared, and market reactions tracked. The information exists, but it is spread across many sources. That fragmentation consumes the time when interpretation is most valuable. Automation should reduce this friction without pretending to replace judgment. A useful system can collect the release, structure the figures, compare expectations, transcribe the webcast, identify changes in management language, connect the quarter with history, and measure the market reaction. It should surface the evidence that deserves attention. The final conclusion still depends on context. A margin decline caused by expansion is different from one caused by lost pricing power. A guidance cut caused by currency is different from one caused by disappearing demand. Automation makes the differences visible sooner. The real opportunity in quarterly reports is the short period when the information is public, but its meaning is still unsettled. That opportunity appears when the result challenges the existing narrative, management changes its language, or the market reaction looks inconsistent with the evidence. The report creates the event. Interpretation determines whether there is a trade. Quarterly reports are not valuable because they produce volatility. They are valuable because they expose the gap between expectation, reality, and price. The market eventually closes that gap. The advantage belongs to whoever can understand it while it is still open.